All right. Good morning, everyone, and welcome to another for our Financials Financial Forum. On today's show, we're talking about the markets and the sector rotation continues again. Um, Big thing in finance and focus. This needs to be your focus. Diversification versus quality assets versus income generation at this time. And finally, we're going to talk about your decision framework and how you make decisions, not only taking this framework from a financial perspective, but also just as it applies to all big decisions in your life. So stay tuned and we'll be right back with Markets in Motion. All right, so we are back with Markets in Motion, and Jeffrey is going to get us started with key moves we're looking at this week.
Yep. So as usual, we'll kind of dive right into the weekly performance, and we had a little bit of shortened week last February to Juneteenth, and we still saw some improvement, a little short week. So S&P 500 was almost a percentage, so 0.93%. The Nasdaq Composite was up 2.43%. The Dow Jones Industrial Average was up 0.71%. And then our international developed markets, that was up 0.96%, so almost a full percentage there. Then drivers kind of from all of this was a U.S.-Iran deal. That kind of from that we had falling oil prices, a Fed hold, and then AI leadership kind of boosting some of those numbers. So as we kind of dive deeper into those daily market drivers, and as the Dow hits 52,000, on Monday we saw a broad rally from major indexes, plus 1% to 3%. So a little bit of an improvement for our major indexes that we see. The U.S.-Iran agreement was announced, as I said, and that drove oil down 5% on Monday. And then on Tuesday, we saw rotation trade. The Dow was up to record an intraday high, that 52,000 milestone that I was talking about earlier. And then we saw the S&P and the Nasdaq fall a little bit on Tuesday. And then our cyclicals, our financials, and industrials, today outperformed than what we usually see, and then tech kind of lagged behind those two. So then midweek on Wednesday, tech rebounded, and that lifted the S&P and the Nasdaq, and that was a little bit stronger than expected. We saw consumer spending data that was stronger than expected, and then the risk on tone was ahead of the Fed decision. We kind of saw some risk circling around there, and then on Thursday, the market rebounding, that was led by chip makers and AI names. And then the S&P posted 11th gain in the past 12 weeks. So a little bit of an up and down week for some things, a consistent rise for others, but a lot happening in that shortened week. So like I said, Friday, we were all for Juneteenth. So
Yeah, exactly. So some of the key things again from this week were the Fed holds the rates. So the Fed funds rates was unchanged. It remained at 3.5% to 3.75%. This was the first meeting under the new chair, Kevin Warsh. They did acknowledge that recent inflation uptick. They reaffirm a 2% inflation target, but it was interesting that the way he framed it, he said the first number. So
mhm.
a lot of economists are saying, okay, so is our target 2.5 or is our target 2.99, and you all are
Mhm.
happy with that? So a little bit of a mystery there as to what that meant, and that's so the market's kind of trying to interpret that, pausing for now. But the potential future hike is definitely been signaled that we probably will see some rate hikes later this year. This week, key economic data. We got services and manufacturing PMI. We got new home sales on Wednesday. Thursday brings jobless claims, PCE inflation, durable goods. The GDP Q1 revision should come out this week. Friday, we're talking about trade balance and retail and wholesale inventories. Of course, light earnings watch as we're towards the end of the quarter. We only have FedEx and Micron reporting this week. So the market tone is kind of risk on because of the geopolitical stuff kind of winding down, hopefully, and AI taking over. Again, we mentioned that Jeffrey mentioned that ongoing sector rotation between tech and cyclicals. So it's kind of keeps going on. And we're expecting the Fed pause for relief, but we are expecting tightening to actually take hold and see those rates go up towards the end of the year, which we'll talk about in our next segment, Finance in Focus. And that's where some income generation opportunities come in. So we'll be right back after the break to talk about Finance in Focus.
And then from that, I kind of get us into some of the corporate strategy and global growth and trade. And a lot of that revolves around Apple this week. And then that comes from, so we had a U.S. industrial policy shift. And from that, we saw Apple and Intel partnering in design and manufacture chips domestically, leading us into onshoring momentum, which is a good thing. So we also saw Apple kind of flexing its pricing power with potential product price hikes to offset component costs. And then some new Apple products, as we all know, we're getting at that time. So product innovation pipeline, and we see the next gen iPhone coming out in 2027. And that signals a continued premium ecosystem strategy, kind of leading off of them flexing their pricing power. So kind of staying in that premium product area. So what the clients will how the clients will be impacted by that will be continued capex in semis and AI supply chain, leading us to tailwinds for tech and industrial sectors. Rising consumer prices, so like I said, that premium pricing, and which is also going to put a potential drag on discretionary spending. So money spending elsewhere is going to drag that a little bit. And then we have some trade uncertainty. That leads to then supply chain volatility, and it reinforces the need for geographic diversification. And diversification is one thing we keep saying throughout this podcast today. So, and then the bottom line for clients, geopolitical um, tensions are easing, and that's supportive. But it's not risk-free given regional tensions. Rates remain a key headwind with tighter policies shaping asset returns. And then global growth divergence is widening, and that's reinforcing the importance of diversification. I keep saying that word, so remember that diversification, and then quality assets, and then income generation strategies. So those are the big things, and kind of the bottom line what we're looking for with our clients. So
Today we are talking about decision making, the science of influence, and your decision framework. So I want to give a little quick background on why I chose this topic today, or why we chose this topic. And this is we fielded a lot of calls from people about SpaceX, and this once we fielded the calls, this is the process we took people through. So we were like, this is a perfect time to share this decision framework process. So Jeffrey, lead us off, and we'll get right into this decision framework process.
yeah. So let's begin with something that might challenge the way we all think about money. And then most financial decisions are not driven by logic; they're driven by emotion. And that's when uncertainty, fear, or stress enters the picture. The brain automatically shifts into what we call get to safety mode. It's simply a survival mechanism. It's designed to protect us, but it doesn't serve us well in financial situations. In those moments, the emotional centers of the brain override the prefrontal cortex, and that's the part responsible for reasoning, planning, and discipline. So instead of asking what's the best long-term decision, we default to what will make me feel better right now. And the gap between short-term comfort and long-term strategy is where many poor financial decisions originate. And selling out of fear, avoiding opportunities, chasing trends. And those are all emotional responses disguised as logical ones.
Yep. And so when you layer cognitive bias on top of that emotional response, decision making becomes even more complicated. So again, our brains are incredibly efficient. They're built to conserve energy. So instead of carefully analyzing every situation, we rely on what's called mental shortcuts, or what we call cognitive
Mhm.
biases. These shortcuts help us move faster, but they also increase the likelihood of error. So also the brain loves patterns. It connects dots very quickly, even when those dots don't truly belong together. So, and in finance, that can be dangerous. Many poor decisions are made not because someone has no information, but because they have some information and assume it's enough. Then we fill in the gaps with assumptions, past experiences, or what feels familiar. That's why we emphasize this idea. Your future is not just about what you invest in, it's about your financial behavior. We recognize who clients are. They're not spreadsheets or algorithms. They're people with emotions, habits, and tendencies. Our role is to help guide better behavior, especially in moments where emotions and biases are trying to take over.
And so, like Marcus said, another powerful force shaping decisions is influence, specifically social influence. And as humans, we're naturally wired to look to others when we feel uncertain. This is called social proof or hurting. We don't feel confident in our own answer. We seek validation from the actions of others. You see it clearly in the financial markets when things are going up. People feel confident because everyone else is participating. When things are going down, fear spreads quickly because everyone else appears to be pulling back. And then the underlying assumption becomes if everyone else is doing it, it must be the right move. But here's the challenge: crowds are often driven by the same emotions we just talked about, fear and excitement. So instead of leading you to better outcomes, following the crowd can amplify poor timing. You can end up buying when confidence is high and prices are elevated, and selling when fear is high and prices are low.
And that's the quiet danger of that social proofing. It feels safe because that's what everybody else is doing, but it doesn't always produce wise results. It removes the discomfort of decision making. She's like, I don't have to make a decision, but it also removes ownership and intentionality. So you're no longer acting based on a plan. You're reacting to what others are doing. So our role is to interrupt that cycle. We aim to be that steady voice in moments when everything around you feels loud and reactive. Space it. It's not about just providing solutions. It's about helping you filter signals from noise. So when that uncertainty increases, the value of discipline increases with it. Real wealth building requires consistency, not reaction. It requires the ability to step back and ask, is this decision aligned with my long term plan? Or is it simply a response to what I'm seeing others do? Because in the end, the most successful investors are not the ones who follow the crowd. They're the ones who stay grounded when the crowd loses direction.
Yeah. So, Marcus, so the question kind of becomes, how do we actually make better decisions in real time? And not in theory, but when emotions are high, uncertainty is present. That's where our decision making framework comes in. It's designed to create a pause between impulse and action. The pause is powerful and it allows logic to re enter the conversation. The first question we ask a client is, where did that idea come from? This helps identify whether the decision is internally driven or externally influenced. Did it come from a well thought out strategy or from a headline or a conversation or social media, which we do see a lot? And then just simply understanding the source often reveals the quality of the idea. The second question we ask is, how does this fit into the plan? Every decision should connect back to a defined strategy, and that's your goals, your timeline, and your risk tolerance. If it doesn't fit, then no matter how attractive it seems, it may not belong. Alignment is much more important than excitement at the end of the day.
Yep. The next question brings accountability into this process. How will you know if you're right or wrong?
Right.
A strong decision includes a way to measure its effectiveness. Without that, you're relying on feelings after the fact, which leads to more reactive behavior. So defining success criteria up front gives you structure and clarity. And finally, how long will this change last? That's the last question we ask. This question is critical because it forces us to identify whether we're making a temporary emotional adjustment or a long term strategic decision. Many financial mistakes we see happen when temporary emotions lead to permanent changes. So, what this framework does is simple, but it's powerful. It slows you down, it shifts you from reacting to thinking, from impulse to intention. And over time, that shift compounds because better decisions repeated consistently lead to better outcomes. Pretty simple.
Exactly. And there's one idea we want to carry with you is this: success is less about what you invest in and more about how you behave when it matters most.
Yeah, our goal is to help you create space between emotion and action so you can make decisions with clarity, confidence, and purpose. Because better decisions over time are what ultimately build lasting wealth.
Yep. Yep. Couldn't say it better myself. And that wraps up another episode of Friar Financial Forum. Thank you again for watching, and be sure to share this one with a friend, as having a decision-making framework can help us more than just the financial aspects of our lives. So have a good one as usual from Jeffrey and Marcus, and we'll see you on the next one.